guys, you're welcome here. Today we learn the engulfing bar strategy. Spotting engulfing bar at a support or resistance level turns out profitable most of the time. 90% of the time it brings a huge profit. I try combining it with the RSI indicator. And here are the three ways I use the RSI indicator. First, I consider the 70 and the 30 level, which is overbought, oversold. Or secondly, I consider it as a momentum indicator. That is, in it, I only consider the 50 level. Finally, I consider the RSI divergence and hidden divergences. If you want to learn any of these, just comment RSI at the comment section and I will make a special video for you, which will also include my special settings. It will help. Do not forget to like, subscribe, and turn on the notification bell so that you follow up whenever we drop a post here. It will surely make you a profitable trader with high success rate far beyond your imagination. Thank you for encouraging us to do more as you subscribe. Now, let's dive into the engulfing bar strategy using candlestick trading Bible. Thank you. We continue today with the engulfing bar candlestick pattern. The engulfing bar pattern is one of the most powerful and profitable price action patterns. Knowing how to use it properly as an entry signal will tremendously improve your trading profitability. In this section, you will learn how to use the engulfing bar pattern profitably. It doesn't matter if you are a beginner or advanced trader. If you are looking for seriously a better trading strategy more than what you've been using, you have come to the right place. What is an engulfing bar pattern? This reversal candlestick pattern consists of two opposite colored bodies in which the second body engulfs or covers entirely the first one. A bullish engulfing pattern forms at the end of a downtrend. It provides a clear signal that the buying pressure has overwhelmed the selling pressure. In other words, the buyers are now involved. A bearish engulfing pattern occurs at the end of an uptrend. It is a top trend reversal indicator. It shows that the bulls are no more in control of the market and the price trend is likely to reverse. See the illustration below. According to Steve Nelson, the father of modern candlestick charting, the candle must meet three important criteria to be considered as a reversal pattern. The market is in a clearly definable uptrend or downtrend. The engulfing candle comprises of two candlesticks, and the first body is entirely engulfed by the second one. The second real body is the opposite of the first real body. How to trade engulfing bar price action signals. To trade profitably this chart candlestick pattern, you need to respect three important elements. Number one, the trend. If you look at any chart, you will notice that there are times where the market is moving clearly in one direction and times where the market is moving sideways. To be honest, trading the engulfing bar pattern with the trend is the easiest way to make money in the market. You don't need to be highly knowledgeable about technical analysis to determine whether the market is trending or not. Make it stupid simple. If the market is making series of higher highs and higher lows, it's about an uptrend market. And if it is making series of lower highs and lower lows, it's simply about a downtrend market. The illustration above shows a clear uptrend. You don't need to use an indicator to determine whether the market is trending or not. Just look at your charts and try to apply the concept of higher highs and higher lows and vice versa. When you're analyzing your charts, bear in mind that the markets move in trends, and trading with the trend is the most important element in your technical analysis. There is no more important than the trend. Don't ever try to fight it or to control it. Otherwise, you will pay expensively for trying. You can't make money under any market conditions, no matter how powerful is your trading system. You have to be patient enough and let the market tell you which direction it's going to take. Successful traders say the trend is your friend, and if you want to master trading the engulfing bar pattern, your first rule is to follow the market direction. In other words, the trend should be your best friend. Number 2, the level. When you find a clearly definable uptrend or downtrend, the markets When you find a clearly definable uptrend or downtrend, the next step is to identify the most important levels in the market. I mean, the most powerful support and resistance. If prices test a support level and stop, this is an indication that buyers are there. This area is watched by all participants in the market because it represents a great buying opportunity. Conversely, if prices test a resistance level and stop in an uptrend, this is a clear signal that selling strength is in the market. The example below shows how the market participants interact with support and resistance level. These levels take different forms such as trend lines, channels, flags, triangles, and your ability to identify them in your charts will help you find better price levels in the market. In trending markets, when prices pass through resistance level, that resistance could become support. See illustration below to understand how to trade the engulfing bar pattern with support and resistance in a bullish or a bearish trend. There are other technical tools that can help us find the best level in the market, such as supply and demand areas, moving averages, and Fibonacci retracement ratios. The third, the signal. The signal here is an engulfing bar pattern. You can apply the same rules when trading the inside bar candlestick pattern. Your ability to identify an engulfing candlestick at a key level in a clear uptrend or downtrend will greatly enhance the probabilities of making a winning trade. See another example below. Trading the engulfing bar with moving averages. Trading the engulfing bar pattern with moving averages provide a very profitable trading strategy. However, the lack of knowledge about using the moving average can damage dramatically your trading account. Traders use moving averages in different ways as a trend following tool to identify the direction of the trend. So they buy the market when prices are above 200 simple moving average, and they sell the market when it is below the 200 simple moving average. To determine whether the market is overbought or oversold, we just watch how prices interact with the moving averages. For example, in an uptrend, if prices move far from the moving averages, this is an indication that the market is overbought. To predict the trend, change by using the crossover strategy. If the moving averages crosses over another, is a signal of a trend reversal. As any trading system, the moving averages have disadvantages. This is why you have to know how to use it successfully under the right market conditions. These trading technical tools doesn't apply to all markets. Don't ever try to use it in range-bound or untradable markets, because you will get a lot of false signals and you will definitely blow your trading account. To the best of my knowledge, using the moving average as a dynamic support and resistance in trending markets in combination with engulfing bar pattern signal is the perfect way to make money in the market. The strategy is very simple. You will use the 21 and 8 simple moving averages in the daily and 4 hours time frame, where we'll define a clear bullish or bearish market and will simply buy when price pullbacks to the moving average and an engulfing pattern forms. Conversely, if the moving average is trending down, it shows that the market is in a downtrend. We sell when prices retrace to the moving average. The screenshot below shows how prices interact with the moving average as dynamic resistance level, and how the engulfing bar pattern represents a high probability setup. How to trade the engulfing bar with Fibonacci retracement. Traders use Fibonacci retracement in different ways. However, the most important Fibonacci retracement level are the 50 and 61 Fibonacci retracement. Knowing how to use these two in conjunction with Japanese candlestick will definitely maximize your profit potential. According to chart technicians, the most major moves retraced around 50% or 61% Fibonacci retracement. This knowledge will provide you with the ability to predict with high accuracy the next major move in a trending market. This strategy is very simple. You define a clear uptrend or downtrend. Then you define major corrective levels by using Fibonacci retracement tools. If you see an engulfing bar pattern matched up with 50% or 60% levels, it's a powerful price action trading signal, like we see in the chart below. In the example above, the engulfing bar price action signal matches up with the 50% and 61% Fibonacci retracement level. The resistance level that becomes support is another confirmation to take this high probability setup. This trading strategy is very powerful. Here is another example below that illustrates the power of 50 and 61% Fibonacci retracement. Trading the market from 50% and 61% Fibonacci levels means you are trading from better price levels As a result, you put as many probability in your favor as possible, and that will allow you to become one of the most successful traders. Trading the engulfing bar with trend lines. Trend lines give traders an idea about the psychology of the market, especially the psychology between buyers and sellers. Moreover, it allows professional traders to determine whether the market is pessimistic or optimistic. This technical trading tool is used in different ways, either as support and resistance by drawing them horizontally, or to identify price and time by drawing trend lines vertically. There is no wrong way in using trend lines. In trending markets, we use simply trend lines to highlight a trend by connecting swing highs or swing lows in price. This way helps us find high probability entry setups in line with the general trend of the markets. See the illustration below. By connecting the extreme highs, we had a trend line that acted as a resistance level, and the formation of the engulfing bar pattern shows a good selling opportunity. If you use just horizontal support and resistance levels, you will miss this profitable trade. Learning about how to draw trend lines is never a bad idea, because it is the simplest analytic tool that you can use to analyze financial markets. It works in all markets, whether in forex, commodities, future, or options. The chart above shows a bullish trend. The trend lines acted as a support level. The price action signal that occurred created a great buying opportunity. How to trade the engulfing bar in sideways market. One of the most difficult markets to predict can be the sideways and ranging markets. I always recommend traders to focus on trending markets. But the problem is that the markets spend more than 70% of their time in ranging motion. If you focus just on trending markets, you will probably leave lots of money on the table. This is the reason why learning how to approach range-bound market is a must if you want to make decent living trading financial markets. What's the range-bound market? When the market stops making higher highs and higher lows in a case of an uptrend, or lower highs and lower lows in a case of a downtrend, the price starts acting between specific high price and low price. This is a clear signal that the market is ranging and no longer trending. See the illustration below. As you see in the example above, the market is trendless. It is trading between horizontal support and resistance, and you can't apply the same techniques that you use in trending market to trade engulfing bar pattern in range-bound markets. Let me give you an example. When you are driving your car, you don't always drive the same way. If you are driving downtown, you try to drive slowly because you know that driving fast can put your life or others' life in danger. But when you are driving in a highway, your driving style changes completely because you know that you can drive fast. So, you always try to adapt your driving style to the appropriate situation. You have to do the same thing when you are trading the engulfing bar pattern, because All price action strategies we discussed before will not work in range-bound markets, and you have to use the right techniques that fit this market condition. Before talking about the right way to trade trendline markets, you have to be selective about trading range-bound markets to protect your trading account, because not all side markets are worth trading. You have to know how to differentiate between sideways and choppy markets. See the illustration below. As it is illustrated above, the market trades in a crazy way. We can identify major support levels and resistance. You have to stay away from these type of markets, otherwise you will definitely damage your trading account. Trading a engulfing bar candle in range-bound markets is very simple. The first strategy is going to be about trading this price action pattern from major support and resistance level like we see below. The second strategy is to trade the breakout of the range or to wait for the pullback. See the illustration below. The third strategy is to trade the false breakout of the major support or resistance level. False breakouts are one of the most powerful price action strategies. It occurs in all types of markets, and if you know how to use it in combination with the engulfing bar pattern in a major support level or resistance, you make money in the market because you will buy intelligently the bottoms and sell the tops. Trading engulfing bar with supply and demand zone. Supply and demand areas are more powerful than support and resistance. It is the place where banks and institutions are buying and selling in the market. If you can identify these turning points, you will make a difference in your trading account. To trade the engulfing bar pattern successfully with supply and demand areas, you have to be able to identify quality supply and demand level on a chart. According to my experience, there are three factors that define quality supply and demand areas. Number one, the strength of the move. Pay more attention to the way the price leaves the zone. If the market leaves the area quickly, it's an indication that banks and institutions are there. Number two, the good profit zone. You have to make sure that the level provides a good risk-reward ratio. Number three, the bigger time frames. The daily and 4-hour supply and demand areas are most powerful zones in the market. The chart below shows a quality supply areas. As you can see, the move was very strong, and that indicates that banks and institutions are there. The formation of an engulfing bar was clear signal that the bears are still willing to sell from the same price level. See another example. I think that it is not complicated to identify these zones because they are characterized by strong moves. The secret behind supply and demand areas is that big players put their pending orders there. When the market approaches these zones, we see a crazy move from these levels. If you can combine trading supply and demand areas with engulfing bar price action signals. You will increase your chances to make money as a trader. So far, you've learned how to identify high probability setups in the market. This doesn't mean you this doesn't mean that all engulfing bar patterns are worth trading. Price action signals with low risk to reward ratios should be ignored. Once the criteria for a high probability setup are in place, there is no more analysis to be made. Just make sure that your trade has a potential of 2:1 risk to reward ratio. I mean that the amount of money you will win has to be twice the amount of money you will risk or more. As you can see, all the conditions were in place to take a buying order. The market was ranging, as we discussed before. Major demand and supply zones are the best price levels in sideways markets. The formation of an engulfing bar in the demand area is a good trading opportunity, but you have to look at the risk reward to make sure that the trade respects your money management rules. This trade has 3:1 risk to reward, which increases your chances to be winner in the long term, because if you risk $200 in this trade, you are likely to win $600. It is very important to calculate your risk to reward ratio before taking any single trade. Imagine you take 10 trades with 3:1 risk to reward ratio on each single trade. I mean, when you win, you get $600, and when the market goes against you, you lose $200. Let's suppose you lost 7 trades and you won just 3 trades. Let's do the math to know if you are a winner or loser. 7 losing trades will cost you $1,400, and 3 winning trades will make you $1,800. As you see, you lost 7 trades, but you are still making money. This is the magic of money management. The entry and exit strategy. Don't try to be smarter than the rest of traders. Keep it simple. You know what you are looking for. When you identify an engulfing bar pattern and you think all conditions are in place to execute your trade, take an order immediately after the price action signal forms. Put your stop loss below the candlestick pattern and look at simply the chart to find the next support or resistance level. This is going to be your profit target. See the illustration below. When you set your protective stop and your target, don't ever look back. End the entry and exit strategy. Don't try to be smarter than the rest of the traders. Keep it simple. You know what you are looking for? When you identify an engulfing bar pattern and you think all conditions are in place to execute your trade, take an order immediately after the price action signal forms. Put your stop loss below the candlestick pattern and look at simply the charts to find the next support or resistance level. This is going to be your profit target, as you see in the illustration below. When you set up your protective stop and your target, don't never look back. Let the market tell you if you are wrong or right. This will help you trade successfully out of your emotions. If the market goes against you, you will not feel good. It's normal. Losing money can be emotionally painful. It's our human nature. Nobody wants to lose, especially when it's about money. In the trading environment, you have to think differently and accept the fact that losing is a part of the game. Studies have shown that successful traders don't risk more than 2% of their equity on each single trade. If you are a beginner, don't risk more than 1%. Don't risk money you can't afford on a single trade, even if the engulfing bar pattern you identify indicates a high probability signal. No matter how smart you are, you have to think always in terms of probabilities. Bear in mind that you can experience series of losing trades, and if you risk too much money, you will not survive longer. Done you well. Please appreciate this our effort by subscribing, liking, and subscribing to this channel. We keep doing our best to make sure you become a profitable trader of your dream. Thank you.